Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about selling options for income using SPY. We're going to toss in QQQ as well. These are two really popular ETFs for trading options. There's lots of volume, lots of open interest. That means it's easy to jump in and out of contracts. There's lots of expiration dates. So two great ETFs to learn about, especially if you're brand new to options. So we're going to take a look at the risks and the rewards that you can have by selling puts and some calls against these types of positions, and what is a realistic return as well. So we'll look at a bunch of examples. So if that is what you're looking for, please stick around. Whoop. Let's start with a quick public service announcement about risk and about selling puts and calls against SPY, QQQ, or any individual stock for that matter. So right now, if you look at the VIX, we're sitting under 13, right? That's a crouching tiger VIX ready to jump up and rip your balls off. That's how I look at it. So everybody currently, going back a year and a half, the beginning of 2023, looks like a genius, right? If you own stocks, you've got all this stock appreciation, you're doing great, or ETFs for that matter. If you've been selling aggressive puts near at the money against SPY and QQQ, you look like a genius. It's free money. I'm just doing this every week, and look what I can generate. You've probably seen some of those videos. Be aware, they probably weren't around back in 2020, March, when the S&P dropped 10%, right? So with options, there are going to be good days and bad days, but options are about compromise, right? So there are going to be times when it feels like free money, but if you haven't been through that period, it can be really rough. So be aware of that as we move through this. So let's start by taking a quick look at a one-year VIX chart. And the VIX, if you're not familiar with it, is our volatility indicator for the S&P 500. So if you're brand new to this, I'll link a video above where I went into a little bit more detail about the VIX, explaining a little bit more about it. But just understand that this is going to drive pricing models for the S&P 500. So when we're selling puts and calls against SPY, we're in a low VIX environment. That means our premiums that we're going to be able to collect by selling puts and calls, it's going to be relatively low. Now, this is a quick snapshot from this past Friday if you wanted to sell an at-the-money put out 4 weeks from today. So with SPY at 541, if you sell the 541 strike, it generates about $580. So how does that sound? Well, that means you're going to collect $580 for selling this put right now. If it expires above 541, you keep all of it. If it falls below 541, well, that's when you start to lose on that option, okay? You have all the way down to your break even that it shows here of 535.19. But if you have a big 10% pullback like we had back in 2020, well, that's going to hit you pretty darn hard. Just want to understand that $580 is what you can generate at the money. We'll take a little deeper look at that as we progress through this. Now, if you wanted to sell out of the money, which is what I typically do, the returns become quite meager quite quickly. So now we're looking at still at 541. We're selling a put July 12th out 4 weeks, but we're dropping down to 525. 525 is 3% out of the money. If you sold 3% out of the money, your max gain is $194. That means it expires above the 525 strike price. But again, if it goes below that, you're going to either take assignment or you're going to start losing value of the option that you sold, and it could result in a loss all the way down to minus $52,306 if the S&P 500 crashes to zero. That's always kind of comical to me. We know it's not going to go to zero, but it's showing you what could potentially happen in a bizarro world, I suppose. So let's put those two into context using my options calculator. So I took that information, I plugged it into my cash secured put calculator so we could look at them side by side. So on this side, we have the at the money put. 6/14 was the date I did the trade or looked at the trade. One contract of SPY with a 4-week expiration out to 7/12. The stock price was 541.50, and I'm selling a put at a 541 strike. Pretty much at the money. And over here, we're doing it at a 525 strike, which is just about 3% out of the money, right? Both 28 days till expiration. And you can see that collecting 581 and 195. Okay, so at the money generates right now in our current VIX environment only a 14% annualized return, which means if we did this every 28 days and repeated it all year long, you're getting a 14% return in a current environment. So you could have been doing that the last 18 months and bragging about it, but if you just owned SPY, you would have done better because it was up, about 25% last year. So in the current environment, not huge returns selling even at the money. And if we went out of the money by 3%, it becomes pretty darn meager. down around 5%. But that is kind of what I tend to do because I'm trying to collect a conservative premium when I sell my puts and my calls on my positions. So just to get some context to us in our current environment, 14% at the money, 4.84%, 3% out of the money, looking out 4 weeks. And then I repeated that exact same process using QQQ. So in this case, 614, same thing, same expiration, but we've switched it over to QQQ. So QQQ was trading at 478.68, and I sold the at the money strike 478, which generated $680 of premium, versus selling 3% out of the money at the 464 strike, generated $275 of premium. So same idea with QQQ. Now with QQQ, we're going to have a little bit more volatility baked into these trades. So in this case, we've got an annualized return of 18.5% at the money and about 7.73% selling out of the money by 3% out 4 weeks. So now let's take a quick and critical look at the different SPY and QQQ option trades that I currently have open. Understanding that these are just simple puts and calls, no defined risk trades, no credit spreads, no debit spreads, nothing fancy, no iron condors, just simple single leg option trades. So we're going to go through these pretty quick, but let's take a look. This is as of Friday, 6/14, when SPY was at 540.70 cents. And I have one put at 5:15, June 14th, about ready to expire. Here's my first critical point. Why do you have this open, Dave? To collect $1. Something terrible could happen, and this $177.32 that you sold this for could be wiped out very quickly. So if I wanted to close this right now, it would cost me $1. Should have closed it a long time ago. Same with these other two. Sold them for $137 and $180, and now they're worth $25 and $11. So if I wanted to close those, that's what that would cost. So in all these positions, I'm doing really well, but I should get off my lazy butt and close them out. And that brings me to a point here. Managing option positions does take time. And I'm going to be doing a video with a friend soon who's semi-retired, retired, that is really focused on covered call ETFs and some of the other things that we discuss. And we're going to see and kind of compare and contrast managing these positions for yourself versus just buying things like SPYI or JEPI instead of doing this type of work. Now, next up, I've got my QQQ trades again here at Fidelity. Let's talk about this first one here. This is a 460 call. So again, it works the other direction too. During a bull market, if you're selling puts, you're doing great. But if you're selling calls against a position that you're building, then it can be a big negative, right? Because you're going to cap your upside at 460 when QQQ is raced all the way up to 476. So while I've had the gain in the stock, I'm losing on this option. I could roll it out further into the future, maybe roll it up a little bit, but it doesn't change the fact that I've capped my upside and I've lost on that option. Okay. Then we've got one at 433, another one at 433 a couple weeks later, and one at 442, July 5th. And again, I've done pretty well. This one probably should be closed out. This one maybe too. This one, borderline. You can decide. You've collected 2/3. Is it time to close it? Probably. De-risk, right? Then finally, I've got a few more over here, and this is E-Trade. So I use both platforms. But I want you to kind of think about how many option contracts I have open that are cash secured puts and how much liability I have out there when I have all these different trades out there, right? If you take assignment of all these, because there's a big pullback in the stock market, right? If we drop 20%, we enter a bear market suddenly. It can be pretty devastating, right? I can lose a lot of money, end up with a lot of shares of two very good products, but that could really hamper what I'm trying to do, right? Which is trying to generate some income. Maybe sitting on those shares for a long period of time. So again, QQQ is at 478. I've got one at 400, 415, 458, 427, and 350. I've collected the vast majority, and most of these. One is down just a little bit. It's 458. So we'll see how that all shakes out. Originally sold these for $316, $161, $191, $251. So collecting a lot of premium, doing okay. But again, you look at these positions combined with your cash position where you might be collecting 5%, and you have to determine, are you doing okay versus wanting to own it? And I've talked a little bit. I've got a large cash position. That's part of my personal situation, but I also have been adding more to my stock positions, and that includes these ETFs. And then SPY down here at the bottom, 499 and 512. Again, collecting the vast majority. Need to close it, get off my lazy button, do it. And this one at 512, where I've collected almost 2/3 again. So those are all the positions that I have open right now, and I just kind of want to show people an example of what I do. So let's talk liability now, because you've seen all my open sold put positions, and these are not defined risk trades, meaning I don't have a long put to go along with them. So if we have a terrible Monday, something happens to the U.S. economy, we get that March 2020 pullback of 10% in the S&P 500, and all these get assigned to me because I was lazy, right? And I didn't close these out when they're only worth a couple bucks. So first of all, I get to flex, right? Because I sold all this premium. I collected a couple $1,000s. I'm feeling pretty good. But then Monday rolls around, terrible Monday. It drops. It continues to decline all the way till these get assigned. In that case, what's my liability look like? Well, on the SPY side, it's about $250,000 that I get to buy of SPY. And on the QQQ side, about $340,000. So altogether, about $600,000 between those two products that I'm going to be buying. Now, these are great products. I don't mind owning them for the long term, and I continue to add to sister versions of these. So it's not a terrible thing, but it is a significant loss. So I'll be talking about that in my next video. Now, if you are looking for a little bit more in-depth information on selling SPY options and QQQ options, I'll link a couple videos above that do just that. They'll go into more depth and talk more about exactly what buttons to push, because this video is more about the risks and about what you could potentially earn by selling at the money or slightly out of the money using these products. So I've heard some disturbing information lately about, individual stocks and the returns and all this kind of stuff, and it always kind of sets me off a little bit. So that was my objective today, to show you what a logical number is behind it. And I'm going to be talking to a friend here shortly that is retired and uses covered call ETFs versus what I do, which is managing a lot of these positions and the time that it takes. We're going to have that whole conversation and that dialogue, which fits in really well with both of our channels. So I think that'll be interesting too. So again, like and subscribe. But hopefully this helps you if you're looking at these types of products and you're considering selling SPY, calls, puts, anything like that. So we'll see you next time. Have a great night. Take care.